ADP Payroll and weekly claims for unemployment insurance. Along with the Employment Situation Report, also known as non-farm payroll, there are two other unemployment reports that sometimes cause the markets to have a big reaction. The first is ADP Payroll. The second is the weekly claims for unemployment insurance. I'll include links for both reports in the text next to the video. The ADP Payroll Report is a monthly estimate of employment levels in the U.S. The data comes directly from ADP Payroll Data, the largest payroll processing company in the United States. Each month, ADP takes a data sample of about 350,000 employees from their database to generate the ADP Payroll Report. The report comes out the first Wednesday of the month, which is just 2 days before the Employment Situation Report, also known as non-farm payroll. For traders, the main use for the ADP report is to attempt to predict how many jobs will be reported, gained, or lost when the non-farm payroll report is released. The ADP report is laid out very similar to the establishment survey in the Employment Situation Report, except it is much more scaled down. There is only a summary page, one table, and a couple of graphs. Once familiar with the layout, reading the report only takes a couple of minutes each month. Just like the establishment survey in the Employment Situation Report, the ADP report measures the number of non-farms jobs gained or lost the previous month. The table gives a total change in jobs for the month. Then, just like in the establishment survey, the data is split into two sections: goods producing and service providing. From there, instead of individual sectors, each section is split into three groups: small companies, 49 employees or less, medium companies, 50 to 499 employees, and large companies, 500 employees or more. The most important statistic in the report is the total number of jobs gained or lost in the previous month, because traders and economists will compare this to estimates for the Employment Situation Report. However, also important is the number of gains or loss specifically in smaller companies. Smaller companies tend to lay off faster during downtrends and hire faster during recoveries, so the change in jobs for small companies is an excellent leading indicator for the economy and GDP. Mostly though, this report is used to help predict if the non-farm payroll numbers to be released 2 days later appear to be in line with estimates. The ADP report tracks the Employment Situation Report pretty closely. In fact, there is over a 90% correlation between the ADP Payroll Report and the final revision of the Employment Situation Report. The ADP report usually does not have a big impact on the markets. However, if the ADP report suggests that the estimates for the Employment Situation Report are way off, the markets could have a big reaction. The other important unemployment report is the weekly claims for unemployment insurance. Released by the Department of Labor every Thursday, this report tracks new filings for unemployment insurance. Because the report is released weekly with current data, it is a good indicator of gauging the present condition of the economy. It is also a good leading indicator for predicting turning points in the economy, as new claims tend to peak or bottom out a couple of months before the economy peaks or bottoms out. The report contains a very short summary and a very small single table. Looking at the table, listed is the initial claims for unemployment insurance, both seasonally adjusted and not seasonally adjusted. The table contains the total claim for the last 3 weeks, the change from the previous week to the present week, and the level from the same week a year earlier. Because the data from week to week can fluctuate quite a bit, the table contains a 4-week moving average. This is much more reliable than the data from a single week. Also included is an insurance unemployment rate. However, because many unemployed people do not qualify for or simply do not claim benefits, the insurance unemployment rate is not a good indicator for the national unemployment rate. The most important use for this report is looking at the trend of the 4-week moving average of initial new claims. If the trend is going down, in other words, there are less new claims for unemployment insurance week after week, it shows the economy is getting stronger. However, if the trend is going up, or the total is already high and stays there, it is a sign that the economy is getting or remaining weak. So that's the ADP Payroll Report. and the weekly claims for unemployment insurance report. Two economic releases that usually don't, but sometimes do, have a large impact on the markets. Since these two short releases only take a couple of minutes to read, it pays for any trader to spend the time reviewing them each month.